but if you haven't, that's okay. Hello. Welcome to the fucking read-along of the One Big Beautiful Bill Part 4. We are on page 21. Oh. Something's wrong with my stream. Isn't that just the way it goes, guys? I guess I have to reset this every time? How annoying. How annoying. Let's see. Let's see what we can do. Did that fix it? Sure did. Love that. Let's just fix everything the way it should have been to begin with. Something is still wrong. Oh. Because I did the wrong thing. There we go. I think we're good now. Alrighty. Good morning. Hope everybody's doing okay. Let's jump right into this here. Oh, something's going on with my... Hi, Tiffany. Thank you for joining me. Please let me know if you can hear me okay in the chat. Yeah, I can hear, bro. Love it. Let's jump into it then. It doesn't look like everything on my end is working all that great. What's going on here? There we go. Now we're good. All right. So today is part 4. We are starting on page 21 of the One Big Beautiful Bill. Starting with section 110212, contributions permitted if spouse has health flexible spending arrangements. So under the current law, individuals are not eligible for an HSA if their spouse is enrolled in a flexible spending arrangement, which is called an FSA. This provision would allow individuals to be eligible for an HSA even if the individual's spouse is enrolled in an FSA. So it seems like this might only benefit people who can afford both, but let's ask ChatGPT to make sure that I'm understanding correctly. Someone's asking what I think about the Jordan Peterson debate, and I gotta tell you, I don't care about anything Jordan Peterson says or does. So currently, if your spouse has a flexible spending account, a type of account to help pay for medical stuff, then you can't have an HSA even if it's their account and not yours. Why? Because the IRS says that having access to their FSA is like you having extra health insurance, and that disqualifies you from having your own health savings account. But that shouldn't really disqualify you, right? So the new rule would fix that, so that if your spouse has an FSA, it won't automatically block you from having an HSA. The super dumbed down version is that your wife before, it was that if your wife has a medical account at work, sorry, you can't have your own. And now your wife has a medical account, no big deal, you can still have your own. Does this help wealthy couples more than less wealthy couples? I mean, the answer is probably yes, because like a lot of things in this bill, the more you can afford, the more these things help you. But, you know, that's kind of just the way everything is, right? It's like, if they lower the price of eggs to $1. Wealthy people are still going to be able to buy more eggs than the non-wealthy people. That doesn't mean that it's not beneficial for the less wealthy. They're still going to get cheaper eggs, right? It's just that they still won't be able to buy as many eggs as the wealthy. So let's see. People are saying they trust the government. Let me know if you trust the government. Okay. Does this help wealthy couples more than less wealthy couples? ChatGPT says yes. This change helps wealthier couples more than lower income couples because wealthy couples are more likely to have both an HSA and an FSA in the household, can afford to contribute the max amounts of both, save more money on taxes because they're in a higher tax bracket, and more likely to know how to use these accounts to get every dollar benefit. Again, the bill is not written to disproportionately help the wealthy. It's just that the wealthy are able to take advantage of it more than the less wealthy. So it's not really the same thing, you know? It's not like less wealthy people can't take advantage of it, but the more wealthy can. Anybody can take advantage of it. The wealthy are just going to be more capable of taking advantage of it, just like price drops of any kind. Someone says that when they abolish the taxes, then I'll trust the government. So you'll probably never trust the government if that's if that's what you need them to do, because I don't foresee them getting rid of taxes anytime soon. Our country's basically been built on taxes. Okay, section 110213, increase in health savings account contribution limitation for certain individuals. So under the current law, statutory HSA contribution limits are indexed every year for inflation. In 2025, annual HSA contributions limits are $4,300 for self-only coverage and $8,550 for family coverage. This provision allows individuals who make less than $75,000 annually or $150,000 in case of families. So this is only for people who make less than $75,000 a year to contribute an additional $4,300 each year to their HSA indexed for inflation. Such additional amounts are phased out for individuals making $100,000 a year. So this seems to be written in a way that helps lower income families more than higher income families. I'm going to check my understanding because there's always a chance that I am not understanding correctly, right? You never know. You never know if you're misunderstanding something. We always try to double check. This is I don't always use ChatGPT to check, but for the purposes of a live, it is much quicker. And we can always delve in if anybody wants me to search for something or has a different idea of how to check the information. Just let me know in the comments. That's why I'm doing it live, so that we can do this together. So right now, if you have a health savings account, an HSA, there is a limit to how much money you can put into it each year. In 2025, you can put in $4,300 if it's just you, or $8,550 if you're covered for the whole family. This limit goes up a little each year with inflation. Okay, but with the new rule, if you don't make a lot of money, you can put in even more than those limits. If you make under $75,000 a year, you are able to put in an extra $4,300 every year. If you make more than $100,000, you do not get the extra amount at all. So if you make more than $100,000, this simply does not apply to you. If you make in between the extra amounts gets smaller, the more money you make. Okay. Now, obviously, if you make, the closer you make to $100,000, the more you're going to be able to save. Someone in the comments is saying, I don't have any money to put in anything. So that's its own problem, right? So if you're not rich, the government says, go ahead and save more. We'll let you put in basically double. But of course, if you're not rich, you're probably less likely to be able to do that. Still, hi, Nick. this can't possibly benefit the wealthy more than the less wealthy because there's a cap, right? If you make over $100,000 a year, then, or over $75,000 a year, this simply does not apply to you. All right, section 110214 is just titled Regulations. Current law is not applicable because there is no current law regarding this. In the new provision, this provision allows the Secretaries of the Treasury and Health and Human Services to prescribe rules and guidance as appropriate to enact the policies in this part. It sounds like that's a blanket provision that just allows the Treasury of Health and Human Services to make up a rule anytime they want. I'm going to just make sure that I'm understanding that correctly because it sounds weird. But let's just see what ChatGPT tells me. This rule gives the people in charge, the Secretaries of the Treasury and Health and Human Services, the power to make the rules and give instructions to help carry out everything in this part of the law. So it is vague. Tiffany says, sounds vague. You're right. I don't know if that provision will allow them to do whatever they want in the future. According to the bill, though, it does need to be in service of helping what is in this section of the bill move forward. And to be clear, and it does say to enact the policies in this part, and every policy that we've read in this part has been beneficial for the non-wealthy. Obviously, it all benefits the wealthy also because everything benefits the wealthy, but it doesn't explicitly benefit the wealthy, so I don't know, probably okay. Tell me what you think. Subtitle B, Make Rural America and Main Street Grow Again. Part 1, Extension of Tax Cuts and Jobs Act Reforms for Rural Americans and Main Street. So section 111001, Extension of Special Depreciation Allowance for Certain Property. Under the current law, taxpayers are generally required to deduct the cost of property used in trade or business over a period of time. However, in the case of certain qualified property, including most equipment and machinery, a taxpayer is permitted to deduct a percentage of the cost in the first year that the property is placed in service. For qualified property placed in service in 2025, a taxpayer is generally permitted to immediately expense 40% of the cost. For qualified property placed in service in 2026, a taxpayer is generally permitted to immediately expense 20% of the cost. This provision allows taxpayers to immediately expense 100% of the cost of qualified property acquired on or after January 20th, 2025 and before January 2030. So this law is retroactive. This would be retroactive going back to January 20 of this year and will go through until January 1st, 2030. And it seems good, right? I mean, obviously, maybe you could say that the wealthy will benefit more from this because the wealthy is more likely to be a business owner and take advantage of these tax cuts. But, you know, I'm a business owner. It doesn't seem like there's a lower end limit. It seems like I would just be able to write off 100% of whatever equipment or machinery I wrote, like this computer that I'm going live for you on every day. If I could write off 100% of it, that's beneficial to me, and trust me, I'm not wealthy. So let's just check my understanding here, because there's always a chance I'm just not understanding what I'm reading here. Instagram keeps giving me a message that my network is having an issue. Is this stream having issues for anybody? Let me know on YouTube. Let me know on TikTok. Anybody else having issues or only Instagram? Why is it only Instagram? Okay, so the rule now, when you buy something big for your business, like equipment or machines, you can't write off the whole cost all at once on your taxes. You usually have to spread it out over a bunch of years, but there's a special rule that lets you write off part of it right away. In 2025, you could write off 40% of it right away. In 2026, only 20% right away, and the rest gets deducted slowly over time. But in this new provision, if you buy that business equipment between January 20th, 2025, earlier this year, and the end of 2029, you can write off the whole cost immediately 100% right away on your taxes. This is beneficial to all business owners, and trust me, not all business owners are wealthy. So I'm going to say that this does not, it may disproportionately help wealthy people, since wealthy people are more likely to be business owners. But it does help the smaller businesses also. It helps anybody who owns a business, even people like me who are far from wealthy, but provide public services or things of that nature, and have to buy equipment to do that. So far, so good, guys. Moving on to Section 111002, Deduction of Domestic Research and Experimental Expenditures. So under the current law, taxpayers are required to deduct research or experimental expenditures over a 5-year period. Research or experimental expenditures that are attributable to research conducted outside the U.S. are required to be deducted over a 15-year period. This provision allows taxpayers to immediately deduct domestic research or experimental expenditures paid or incurred in taxable years beginning after December 31st, 2024, and before January 1st, 2030. So this provision includes rules to coordinate the immediate deductibility of domestic research or experimental expenditures with the research credit, rules clarifying the treatment of foreign research or experimental expenditure, and other coordinating changes. I didn't fully understand all of the second part, but it seems like, once again, if you're a business owner, you get to write off these things immediately 100%. What's up, Black Sheep? Welcome back. You're apparently still marked as a moderator, so I really appreciated your help yesterday, and I hope that you're able to kick anybody who says rude things today. Thanks, Mr. Chingun-san, who says he gives a shit, and that's why he follows me. Thank you, thank you, thank you. Let's ask ChatGPT to explain this like I'm stupid. Because honestly, that second part did make me feel a little stupid. It just kind of went right over my head. I really didn't understand what the second part of it is. And what is an experimental expenditure? So the rule is now, if a business spends money on research or experiments like developing a new product, it can't write off all the costs right away. For US-based research, you have to spread the tax deduction out over 5 years. For research done in other countries, you have to spread it out over 15 years. Under the new rule, starting in 2025 through the end of 2029, businesses can write off all the money they spend on U.S. research immediately, not little by little. Foreign research still has to follow different, slower rules. It also updates some stuff behind the scenes to make sure this works properly with other tax rules like the research credit. To spend money on research in the U.S., go ahead, write it all off right now. Big tax break, fast, for any business owner who does this. Let's just ask, give me 5 examples of experimental expenditures. Sounds like if you have to develop like a test product or something like that, then that's kind of what it entails. So if a company spends money trying to invent a new kind of battery, all the cost, materials, employee time, and testing are Wow, that includes employee time, costs for materials, etc., creating new software. If a tech company is building a new app or software system and is experimenting with how it works or how to code it, that's a qualified research expense. Testing prototypes, improving a manufacturing process, developing a new type of seed or fertilizer. I think this is okay. Yes, it benefits big business, but it's okay. It doesn't, again, this isn't something that takes away from other people and puts it in the pockets of of the people, if they're experimenting, if they're doing research on new products and things like that, they used to have to... Let's ask ChatGPT, why did these expenditures originally need to be drawn out over years? Because, I don't know why that was in place in the first place, right? Why would that matter? Oh, it's not going to give me an answer. Okay. Okay. Let's see. Because I'm curious. Why was that law originally in place? There must have been a reason, right? I have to assume it was done for a reason and not just because Democrats are evil and want businesses to not get tax credits or something. Hit that like button and follow. Thanks, Black Sheep. Yeah, please like, subscribe, follow me in all the other places, Instagram, TikTok. Substack's a really important one. Lots of extra content, different content in all the places. I'm trying to keep you guys informed, but there's a lot to do. So because the government wants to match tax write-offs with how long the benefit lasts. Imagine this. A company spends $1 million in 2024 to develop a new drug. That drug might make them money for 10 plus years. So the IRS says if the benefit of the thing you built lasts for years, then you can't write it all off in 1 year. That's like cheating. You need to spread the write-offs over the years that the benefit is happening. So they made companies spread out the tax break over 5 years to match the long-term benefit. They also wanted to slow down how fast companies cut their taxes. So if everyone could deduct huge research expenses all at once, it would make tax bills drop a lot in 1 year, and that would reduce tax revenue that the government collects all at once. So slowing down the write-offs helps keep the government income more stable. Okay, so that just keeps large amounts of money coming in over like gradually over a long period of time, which I understand that the... Tiffany's saying, where is everybody? Yeah. I don't know. Few reviews today. I am doing it at kind of a weird time, so maybe it has something to do with that. I also posted online that I'd be on about 30 minutes before I was, so that's my mistake. I was a little late. So now with the new rule, it's like, okay, fine, you can take it all now, but only for research done in the US and only for a few years. Basically, only until it expires in 2029. So... yeah, this doesn't spread out. The money that the government would get is no longer spread out. They basically have to give these tax breaks all at once, which may negatively impact the amount of taxes that come in the first year, but it certainly doesn't, ultimately they're still giving or taking the same amount of money. Moving on. Section 111003, modified calculation of adjusted taxable income for purposes of business interest deduction. Under the current law, the deduction for business interest expense for a taxable year is generally limited to the sum of 1, the taxpayer's business interest income for the taxable year, 2, 30% of the taxpayer's adjusted taxable income for the taxable year, and 3, the taxpayer's floor plan financing interest for the taxable year. Adjusted taxable income corresponds with the financial accounting concept of earnings before interest and taxes, EBIT. Floor plan financing interest refers to interest paid or accrued on indebtedness used to finance the acquisition of motor vehicles held for sale or lease to retail customers and secured by the inventory so acquired. A motor vehicle means a motor vehicle that is one, any self-propelled vehicle designed for transporting... they need to define a motor vehicle. Transporting person or property on a public street, highway, or road. 2, a boat, or 3, farm machinery or equipment. This provision increases the cap on the deductibility of business interest expenses for taxable years beginning after December 31st, 2024 and before January 1st, 2030. So again, this expires December 2029. Specifically, it provides that adjusted taxable income is computed without taking into account deductions for depreciation, amortization, or depletion. You know, I don't know what amortization is. I've got a pretty good vocabulary, but I don't know that one. Before I look it up, anybody know what amortization means? Let's learn together. In accounting, amortization is a method of obtaining the expenses incurred by an intangible asset arising from a decline in value as a result of use or the passage of time. Amortization is the acquisition cost minus the residual value of an asset calculated in a systematic manner over an asset's useful economic life. So it's really about the depreciation, I think, of what you're writing off. I'm just going to ask ChatGPT to explain that like I'm stupid because there were a lot of big words in there. I think I got it. I'm pretty sure that I understood, but let's just make sure that we're all on the same page here. Amortization is a fancy way of spreading out the cost of something that you can't touch, like a patent, trademark, or software. Because you paid a lot up front, but the thing you bought loses value slowly over time, so instead of counting all the cost at once, you break it into smaller chunks and spread it out over the year to use it. So let's say you buy a software license for $10,000 and it'll last 5 years. Instead of saying, I lost or spent $10,000 this year, you say, I lost $2,000 each year for 5 years. That's amortization. Great. Okay. Now, as a result, adjusted taxable income corresponds with the financial accounting concept of earnings before interest, taxes, depreciation, and amortization. This provision also permanently modifies the definition of motor vehicle to include certain trailers and campers designed to be towed by or affixed to motor vehicles. The change allows interest on floor plan financing for such trailers and campers to be deducted. So it adds trailers and campers to the list of motor vehicles, and it lets you spread out the taxable part of your purchase. That's my understanding. Let's just make sure I understood correctly. Mark Diamond Jr. says, why the country can own trillions, but if we own 10K, we have a bad credit score. Well, that's, that's how the man keeps us down. Don't fight it. You can't fight the man. What's the rule now? So if a business borrows money and pays interest on the debt, it can only deduct part of that interest on its taxes. The amount they can deduct is based on their adjustable taxable income, basically how much money the business made before interest and taxes. That's called EBIT. The new rule from 2025 to 2029, businesses can now calculate that income as EBITDA, which means earnings before interest, tax, depreciation, and amortization. So they can ignore even more deductions when doing the math, which makes the income number bigger, which means they can deduct more interest. So they don't have to write off all of their expenses, basically, all at once. The rule also says, hey, if you're a business that finances trailers or campers, we'll now count those as motor vehicles too. That means businesses like that can now deduct interest on loans used to buy trailers and campers for resale, just like they already can for cars and trucks. That seems fine. They should be able to do that. Campers and things should be included in anything related to cars and trucks, right? Because it is like a car or truck. Before, you can only write off interest on your loans up to a limit, and we use EBIT to figure it out. Now you can write off more interest because we'll use EBITDA instead, which is a bigger number. Also, if you sell trailers or campers, now we'll treat them like cars, so you can write off that loan interest too. So this does benefit business owners, specifically ones who buy, sell, or use motor vehicles in their business. But again, that's not... It helps business owners. I'm not going to say that helping business owners is going to trickle down to non-business owners, but, well, it could. Likely not, but it could. And again, it's like... This doesn't sound negative. Is there any negative side of this? Maybe there's something I'm not seeing or getting. It's true that this provision obviously does not help the poor or something like that, but letting businesses deduct more interest means that they might think, cool, let's borrow more money, but too much debt, more financial risk, especially if the economy goes bad or interest rates go up. That can lead to defaults, layoffs, or bankruptcies later. Okay, so it has the potential to lead to more bankruptcies. Not that it will, it just has the potential to do so. Less tax revenue for the government. If businesses deduct more interest, they pay less in taxes. That means the government collects less money. Less tax revenue equals potentially less money for public services like roads, schools, healthcare. But as we know, those things are being reduced as we speak. Favors big debt-heavy companies. So this helps companies that borrow a lot, like big manufacturers, auto dealers, or private equity firms. But small businesses or companies that don't use much debt, they don't benefit as much. So it's kind of uneven. Okay, the same wealth distribution issue, right? Of course, companies that take on more debt are going to be able to take advantage of things that help with debt, etc. Temporary boost, long-term trouble. This is a temporary rule, 2025 to 2029, but businesses might rely on it, and when it expires, they could get hit with higher taxes and surprise losses. So if you're still doing this up to December 2029, you might be fucking yourself if the rules change in 2030. It's basically like telling someone, you can write off more stuff now, go ahead and use that credit card. It feels good short term, but later, if things go wrong or the rules change, it can backfire. But that's... You could say that almost about anything, right? I mean, anything could backfire. Healthcare and education are woke, says Jay Mason. And again, that section, sure, it may benefit the wealthy or business owners who use or buy or sell cars, campers, etc. more than the poor, but it's not something that takes money away from things that would help the poor. In fact, it looks like it has the chance of being really negative for businesses in the future, but in the short term, right now, it allows them to spend more, take on more debt, which, you know, assuming that the economy doesn't totally crash, could just not end up being a bad thing. It also, I think, will probably allow more startup businesses in those, right? If they're able to write off more. Okay, moving on. Moving on to section 111004, extension of deduction for foreign-derived intangible income and global intangible low-taxed income. Under the current law, a U.S. corporation is allowed a deduction of 37.5% for its foreign-derived intangible income and a 50% deduction for its inclusions with respect to global intangible low-taxed income. These deductions will be reduced to 21.875% and 37.5% respectively for taxable years beginning after December 31st, 2025, beginning at the end of this year. This provision will permanently increase the deduction amount for foreign-derived intangible income from 21.875% to 37.5% and increases the deduction for global intangible low-taxed income from 37.5% to 50% for taxable years beginning December 31st, 2025. Man, that is a lot of legal tax jargon that is just a little confusing to me. I think I get it. It seems like it's just, reducing taxes for companies that have intangible income overseas. Let's just explain this like I'm fucking stupid. That's what we're trying to do. I would just want us all to understand. Right? So that when you're having a discussion with someone who says this bill is all bad or all good, you can talk about it. Amortization was not one of the things I was thinking about when I voted. If I get this, you now can't deduct as much income derived from other countries. Right. That's probably, I think that you get it. But let's just see. Big US companies that make money from stuff they create, like patents, software brands, and sell to other countries, get a special tax break. It's not if they manufacture it in other countries. It's if they sell it to other countries, they get a special tax break, which is interesting. This is probably related to bringing business back to the United States, right? Because we're saying, like, don't manufacture it there, manufacture it here, and then we'll give you a tax break for what you sell back over there. They also get a break on foreign profits made by their branches or subsidiaries overseas, but only for certain kinds of income the government considers intangible and lightly taxed. So right now they get a 37.5% deduction for money earned from foreign sales of intangibles, called FDII, and a 50% deduction for income from foreign operations. But starting in 2026, the law was going to cut those tax breaks in half. The new rule says, let's keep the bigger tax breaks forever, so even after 2025, companies still deduct 37.5% of their foreign-derived intangible income and 50% of their global intangible low-taxed income. So before, in 2026, big companies were going to lose some of their cool tax breaks for making money overseas, and now they won't. I feel like this only helps big businesses because small businesses are not obviously selling a lot overseas, but let's just ask. Let's see what it says. Let's just see if this helps small businesses at all, or if it's only for big businesses. This mostly helps big multinational corporations and not small businesses. Okay. This tax break is specifically for companies that sell stuff overseas or have offices or branches in other countries. Big international companies like Apple, Google, Pfizer, or Microsoft, not your local pizza place, hardware store, or small online businesses. So small businesses don't benefit because they don't usually have foreign income or foreign subsidiaries. They're not selling intellectual property worldwide, and they're not affected by GILTI or FDII rules at all. So this one only helps big business. Again, it doesn't take anything away from smaller businesses, but it does help big businesses only. Moving on. Section 111005, extension of base erosion minimum tax amount. So under the current law, the base erosion anti-abuse tax imposes a 10% minimum tax on corporations with annual gross recipients in excess of $500 million and base erosion payments above a certain threshold for taxable years beginning after December 31st, 2025. The 10% rate will increase to 12.5%, and credits computing the tax will no longer be allowed. This provision permanently reduces the rate from 12.5% to 10% beginning January 1st, 2026. The provision also permanently retains the current treatment of tax credits for taxable years beginning December 31st, 2025. Okay, so this seems to be something else that only benefits big businesses. I'm just going to double check my understanding here. Just always want to check our understanding because I think I understand sometimes and then I'm wrong. And we don't want that. I want us all to be well informed, right? Not misinformed. So, what's the rule right now? Big companies, those making over 500 million a year, sometimes move profits to other countries to pay less in taxes. That's called base erosion. So the government says if you're doing that, we're going to hit you with a special extra tax, a minimum of 10%. But starting in 2026, that tax was going to go up 12.5% and not let you use tax credits to lower it anymore. The new rule says keep the 10%, it's not going to go up, and you can still use your credits. So big companies won't get hit harder starting in 2026 like they were expecting. So it was set to go up, now it's not going to go up. It doesn't remove the tax. It just keeps it at what it is currently instead of allowing it to go up, which was what was going to happen. So before, big rich companies using overseas tricks, we're going to charge them more starting in 2026. And now we are simply not going to charge them more than we already do. They still have to pay their extra 10% tax for doing that. I used to think I understood things back before about 2016. Yeah, exactly. There have been so many things that I thought I understood in the last few years that I realized maybe I don't. Some things and things aren't even clear anymore. Some things were obvious and now not even more. Yeah, Kellerman, who saw Elon bad-mouthing this bill because it undoes Doge's work? I'm going to do a mini watch-along for that little quick interview with Elon Musk because that is interesting that he spent all that time supposedly saving the government money only for it all to get spent and more in this one big, beautiful bill. All right, moving on to part 2. This is the additional tax relief for rural Americans and Main Street. What does Main Street refer to? Anybody want to guess what Main Street means before I... Oh, come on. Guys, please like and share, get the word out there. Spread this video. Get people in here. Comment. Do all the things that equal engagement so that we can get people watching, commenting, telling me what I'm missing, etc. The idea here is that we all learn together. When people say Main Street, they're talking about regular, everyday small businesses. The donut shop in your neighborhood, the family-run hardware store. Okay, so this is an additional tax relief for rural America and Main Street, which is local donut shops, family-run hardware stores, local barber shops or hair salons, etc. This should help the small businesses. Section 111101, Special Depreciation Allowance for Qualified Production Property. Under the current law, taxpayers are generally required to deduct the cost of non-residential real property over a 39-year period. This provision allows taxpayers to immediately deduct 100% of the cost of certain new factories, certain improvements to existing factories, and certain other structures. I gotta be honest. When I think of small businesses, I do not think of factories. Specifically, this provision allows taxpayers to deduct 100% of the adjustable basis of qualified production property in the year such property is placed in service. Qualified production property is defined as the portion of any non-residential real property that meets the following requirements. 1. The property must be used by the taxpayer as an integral part of the qualified production activity. 2. The property must be placed in service in the U.S. or a U.S. territory. 3. The original use of the property must begin with the taxpayer. 4. The construction of the property must begin after December 31st, 2025 and before January 1st, 2030. 5. The property must be placed in service before January 1st, 2034. And 6. The taxpayer must have elected to claim an immediate deduction with respect to such portion of the property. A qualified production activity generally means the manufacturing, production, or refining of tangible personal property. An activity generally does not count as a qualified production activity unless it results in a substantial transformation of the property comprising a product. The term production is limited to agriculture production and chemical production. So this is specific to agriculture and chemical production, apparently. Some of the requirements described above are relaxed in the case of a taxpayer that acquires a property that was not used for productive activities during the period between January 1st, 2021 and May 12th, 2025. This special rule could apply, for instance, to a taxpayer that acquires and rehabilitates a factory that was abandoned in 2020. So this helps people, if I'm understanding correctly, it helps people rehabilitate these factories that have been abandoned and gives them a tax break for doing so. Any portion of a property that is used for offices, administrative services, lodging, parking, sales activities, research activities, software engineering activities, or certain other function is ineligible for this benefit. Recapture rules apply in certain cases where during 10-year period... Well, how am I getting a phone call? Everything's on Do Not Disturb. Recapture rules apply to certain cases where during the 10-year period, after qualified production property is placed in service, the use of the property changes. That was a lot. That's a big one. That is a big one. So let's just have ChatGPT explain that to me like I'm stupid. Really, it's for your benefit, not mine. Let's be honest. I'm just kidding. Just kidding. Yeah, Kenya says it's cool if they're using old and abandoned buildings versus building new ones. I agree. Okay, so the old rule is if you build a factory or a big building for your business, but not a home, you cannot write off the costs all at once. The IRS says you have to spread the cost out over 39 years. So if it costs $3.9 million, you'd only get to deduct $100,000 each year on your taxes. With the new rule, if you build or fix up a factory or certain type of buildings used for making stuff in the U.S., you can deduct the full cost right away. Boom, 1 year. But only if the building is used for real production stuff like manufacturing, refining chemicals, or growing food or doing farming. So this is specifically to help the manufacturing and farming sectors. So what doesn't count? If the building is used for offices, research, sales, software development, parking lots, this does not apply. If you buy an old factory that's been shut down since before 2021, you can still qualify for this break if you fix it up and use it to make stuff again. The catch is, if you say, I'm going to use the factory for production, but later switch it to something else, the IRS can make you pay some of the tax break back. So the super dumbed down version is this. Before, if you build a factory, you have to wait 39 years to fully write it off. You can only write off partially over 39 years. Now, if you build or fix up a U.S. factory used to make real things, you can write off the whole cost immediately, but no tax breaks unless it's specifically being used for those few things. So this is another thing that is beneficial. It's more beneficial to big businesses than small businesses, obviously, because small businesses are not going to be building $1 million offices and things of that nature. However, since it's specific to these particular industries, to agriculture and all these things, I would say this is a good thing for all of us. If it is cheaper for a farmer to start a new farm, we need farms. You know, this is, in my opinion, this is directly related to bringing farming, manufacturing, those sorts of businesses back to the United States. It incentivizes those people to rehabilitate old factories, to build big, over time, the government will get the same amount of money, they just get it all up front. Or they have to give the tax break all up front instead of it being extended over such a long period of time. But again, I think this really just incentivizes them to, use an old standing office building for their businesses. And it's only for farmers or chemical production. So we need those. We need those to come back We need more of them, even if they're not coming back. We need more of them. And incentivizing that, I think, is okay. Jay Mason says, my overall prevailing thought is the majority of what I have heard are very insignificant things compared to what I expect. This one seems fairly big, however. This is a big deal. It is a big deal. But once again, it's not something, I guess we have to wait and see what the long-term effects are. If a lot of people take advantage of these tax breaks all in the first year, then that means that the government will receive less in taxes in the short term. But if they get all that money back all at once, then they are, they're still going to have to, they still have to pay it all. They still pay the same amount. It's just over time. It doesn't get slow released. Kenya's asking, are you going through any other portions of the big, insanely massive bill other than just the 50 pages? There are only 50 pages in the bill. There is nothing else to go over other than the 50 pages contained in the bill. Let's just ask ChatGPT if that provides us with a net positive or a net negative. I'm curious what it says. Estimate whether this will have a net positive or net negative impact. Okay, so the potential positives are more factory building. Businesses may be more willing to build or fix factories in the U.S. because they get a huge tax break all at once. Could help revive abandoned or struggling areas. It could also lead to more jobs, new or reopened factories, more people hired to run them. Could boost local economies. More U.S.-based production, and it encourages companies to make stuff in America. Just like I said, my understanding of this was perfect. The big, beautiful bill is over 1,000 pages. Oh, hold on a second. What? What am I reading? Yeah, I guess you guys are right. It's 1,000 pages long. We're only looking at 50 pages. I don't know. Do I even have access to the full 1,000 page document? I'll look into that more for you guys. I'll look into that. For now, we're just doing these 50 pages of what's been provided. Section 11102, Renewal and Enhancement of Opportunity Zones. So under the current law, opportunity zones, or OZs, exist as a temporary policy that have been used as an economic development tool to revitalize distressed communities across the country. Created in the Tax Cuts and Jobs Act in 2017, passed by Donald Trump, OZs are census tracts that meet the definition of low-income community and that were nominated by state governors and certified by the U.S. Department of Treasury as eligible areas for qualified investments to be made in exchange for certain tax benefits. The program was created as temporary policy existing over a 10-year window as an initial round of OZ development. Then it's got some definitions. This provision creates a second round of OZs, making adjustments and improvements to the previous policy. Specifically, the definition of low-income community is narrowed to census tracts that have a poverty rate of at least 20% or a median family income that does not exceed 70% of the area median income. Additionally, a guardrail is added to ensure that the term low-income community does not include any census tract where the median family income is 125% or greater of the area median family income. See, now already, when I read that, I immediately think of all the things I've heard that it is like, you know, this will like end benefits for a bunch of people. However, it seems to be limiting how much people can take advantage of this when they're not technically low income. That's what I'm seeing here. I could see how you could read that and think, oh, well, a bunch of people are going to lose their ability to apply for this, but it's limiting it to just the people who really need it. People who make less than 125% of the area median family income. This provision maintains the OZ designation process from the Tax Cuts and Jobs Act and adds that at least 33% of designated OZs must be comprised entirely of a rural area. In the case that there are fewer than 33% of rural qualified OZs, all eligible rural areas must be designated. A rural area is defined in the Consolidated Farm and Rural Development Act. Additionally, this provision makes contiguous tracts ineligible for OZ designation. I hope I get all these words right because I'm certain that contiguous is correct. But boy, do I hate when I'm watching somebody read something live and they're just like mispronouncing words all over the place. It really makes me lose respect for them. So if I mispronounce something, please let me know. I know rural is a weird, difficult word to say in a sentence, so every once in a while it's going to come out differently. It's going to sound like rural, or, you know, I'm also from the South originally, so we're real rural around there, you know what I mean? So, rural. I'll do my best to pronounce it correctly, but furthermore, the provision simplifies the investment incentives and creates rural qualified opportunity funds. Investments made in a QOF receive a single step-up in basis of 10% when held for at least 5 years. In rural areas, investments must be made into a RQOF and will receive a 30% step-up in basis when held for at least 5 years. Additionally, taxpayers may choose to invest up to $10,000 of post-tax ordinary income into a QOF or RQOF, and a special rule is created that lowers the substantial improvement threshold of existing structures from 100% to 50% in rural areas. And lastly, this provision adds reporting requirements for the OZ program. Reporting requirements are good. If the government's giving people money, we need to have reporting requirements. I think that something that people are finding out now that they don't necessarily like about the way the Biden administration was doing it was that some of these things were simply not being kept track of. Okay, the second round of OZs will begin in January 1st, 2027, and the end of December 31st. So that was sort of big and complicated. I'm going to have ChatGPT simplify this for us. Black Sheep, you're awesome. Black Sheep, can you message me on Instagram or something and let me know who you are? I would love to give you a shout out. You're really, you're great. I really appreciate you. And if you're on Instagram or TikTok, you should really jump over to youtube.com/Kellerman Comedy, because then you'll be able to like actually read along with what we're talking about. Okay, so opportunity zones. They're poor neighborhoods the government wants rich people to invest in. So they say, hey, rich folks, if you put your profits into these struggling areas, we'll give you a sweet tax break. Now, this could be interpreted either way, right? Because it is a tax break for the wealthy, but only if they invest in struggling areas, which is good. We want the people with money. Like that's wealth division, right? We want the people with money to invest that money in struggling areas. We want to bring up the struggling areas. And the only way to do that is with money. So how it worked before was rich people sell stocks and property, make money, and normally owe taxes. But if they put the profit into a special investment fund called a QOF, and that fund invests in poor areas, then they do not have to pay a tax on that profit right away. It gets delayed. If they keep the investment for 5 to 7 years, they get a discount on the taxes that they owe. And if they keep it for 10 years, they never pay taxes on the new profits they made from the investment. This original program ends in 2026, at the end of this year. The new law, they're rebooting the program in 2027 with some changes. So this will still end in 2026 and be gone for a year. But then in 2027, there will be a narrower definition of poor neighborhoods. So before, low income meant 80% of the area's income. Now it must be 70% or less. So now we are focusing that money into really poor areas, into the areas that really need it, and they can't just be on the cusp of needing it. They really need to need it. And if the area makes 125% more of the area's income, then they're not allowed. Rural boost. At least 1/3 of all new zones must be rural, or all of the rural areas if there aren't enough to make up a third. Rural areas also get a better deal. If you invest in them and hold it for 5 years, you get a 30% tax break, not just 10. So we are further incentivizing the rich people to put money into struggling areas. You can fix up buildings more easily. Before, to count them as an improvement, you had to double what a building was worth. Now, in rural areas only, you only have to improve it by 50%. Again, this is an incentive, because before, if you didn't think you could double what the building was worth, then you were not going to be eligible for this. Now, you just have to improve it enough. You just have to improve it some 50% to be able to take advantage of this. New option for small investors. Regular people can now put up to $10,000 of normal money and not just capital gains into these OZs. More reporting, the government is adding transparency rules so people can't just pretend they're helping poor areas to dodge taxes. Okay, the government is adding transparency rules. This is the reporting part. And this is what prevents rich people from taking advantage of this program and using it in ways it should not be used. All right? That's good. This part right here. This part here. This is good. This prevents rich people from using this provision as a loophole to save money when they shouldn't. That's objectively good. I don't care which side of the aisle you are on. That is good. So before, rich people, if you invest your profits in poor areas, you get a big tax break, and that ends in 2026. Now, they're going to start it again in 2027, but making it stricter. So it is the poverty line basically has been moved down to help the really in-need areas. More rural focused, right? At least a third of what you invest in has to go to rural areas. And more fair, hopefully. So it's a second chance to use taxes to fix up poor places, especially in the countryside, aka rural areas. This is good for rural areas. This is good. This is a good one. This is a good one for everybody. I mean, again, you could probably frame this in a way that it's only beneficial to the wealthy because it's a tax break that only they can take advantage of, but they can only take advantage of if they're putting that money in a place that helps unwealthy, like poor areas. So that is good for everybody. Anthony Grover says transparency doesn't necessarily mean regulated. That's true. But if it is transparent, if the reporting exists, we should be able to more easily find fraudulent behavior if we go looking for it, right? Okay, this is the last section I'm going to do today. I wanted to do 10 pages a day, but man, it really takes a long time. Okay, so section 111-103, increased dollar limitations for expensing of certain predictable business assets. Under the current law, can you read this? Under the current law, IRC section 179, A taxpayer may elect to expense the cost of qualifying property rather than to recover such costs through tax depreciation deductions, subject to limitation. Under current law, the maximum amount a taxpayer may expense is $1 million of the cost of qualifying property placed in service for the taxable year. The $1 million amount is reduced by the amount by which the cost of such property placed in service during the taxable year exceeds $2.5 million. The $1 million and $2.5 million amounts are adjusted for inflation for taxable years beginning after 2018 and are $1.25 million and $3.13 million in 2025, respectively. In general, qualifying property is defined as depreciable, tangible personal property, off-the-shelf computer software, and qualified real property that is purchased for use in the active conduct of a trade or business. This provision increases the maximum amount a taxpayer may expense under IRC Section 179 to $2.5 million, reduced by the amount by which the cost of qualifying property exceeds $4 million. So if they spend $4 million or more, they get a larger tax break than they did before. The $2.5 million and $4 million amounts are adjusted for inflation for taxable years beginning after 2025. The proposal applies to property placed in service in taxable years beginning after December 31st, 2024. That was a confusing one. That was, I gotta be honest, I didn't get a lot of that one. Not a lot of that stuck as I was reading it because it's a lot of numbers. So let's just ask ChatGPT to explain it like I'm stupid, because in this case, I am. So, the old rule was, if you run a business and buy stuff like equipment, computers, furniture, software, or even fix up your store or office, you could write it off. You could write off some of the cost right away on your taxes instead of spreading it out over many years, but there are limits. You can only write off up to $1.25 million. If you spent more than $3.13 million total on stuff that year, then the write-off starts shrinking. So businesses that spend more than $3 million, their write-offs get less and less and less. That's the current way that it is. The new rule, the limits are bigger now. You can now write off up to $2.5 million in 1 year. The shrinking starts when you spend more than $4 million on stuff. So you can write off more stuff and it takes longer before the benefits start getting cut down. The super dumbed down version is, you're a business, you buy tools, gear, upgrades. The government used to let you write off some of it right away. Now they let you write off more of it right away. This is good news for business owners who spend a lot on equipment. Obviously, this provision benefits businesses, bigger businesses, right? Because smaller businesses are not spending over $2 million a year on equipment. That said, it's just another thing that, yes, this particular part benefits big business, but it doesn't not benefit small businesses. It doesn't give them any sort of, it still encourages them to spend more money. And that's how they receive the incentive, that's how they get more money back, is by spending more money. We want them to spend more money. That's how our economy grows and stays sufficient. So estimate whether this will have a net positive or net negative impact on the U.S. economy. What do we call the Kellerman comedy community? Well, we can't call it can't be triple K. You can't spell community with a K. Definitely not. I don't know. I need a fucking news community name. What are you guys? The fuckers? The fucking newsers? All right, the last question I'm going to ask ChatGPT is whether I'm asking it to estimate whether this will have a net positive or net negative impact on the U.S. economy. It's very likely to have a net positive impact on the U.S. economy, especially in the short or medium term, and here's why. Businesses will spend more. If companies know that they can write off big purchases faster, they're more likely to buy new machines, tools, software, and tech right now. That also helps us keep our infrastructure newer. More money for small and mid-sized businesses. This is mostly used by small and medium businesses, not huge corporations. That means Main Street benefits more than Wall Street. More hiring, more productivity. When businesses buy new stuff, they often need people to install, maintain, or use it, which can lead to new jobs or better pay. This also helps during inflation. If things cost more, this lets businesses still invest in themselves without worrying as much about the long-term tax burden. So why it's not perfect. Less tax revenue at first. So the government will get less money up front since businesses are taking big deductions right away instead of spreading them out, and could mostly help businesses that already have money. So you have to be able to afford expensive stuff, obviously. You have to be buying things. If you're not buying anything, then you don't get any tax benefit for buying things. That seems kind of obvious. Net positive for the economy overall. Great for growing businesses, short-term costs to the government, but likely pays off over time by boosting investment, productivity, and jobs. So while it's not magic, it is, according to ChatGPT, a smart way to encourage business growth. I'm going to stop there. Again, I haven't seen anything that takes from the poor and gives to the rich yet. Not yet. We're on page 25. I will be back tomorrow to start on page 26. Thanks for watching. I hope you enjoyed this read-along. I hope we all learned something together. Please like, subscribe, tell all your friends. I'm trying to build up the YouTube here, so, we want to be able to get to the point where you're able to super chat me, and then I can shout people out, and I can give people rewards, all these different things. So, Kellermanti? I think... No, that's not a good one. I don't like that. We got plenty of time to think of a group name. Obviously, I'm still only on page 26 out of 50, so there will be more of these. Please make sure you subscribe so you get notified when I go live. Also, make sure you're following on Instagram or TikTok, and definitely on Substack, theforkinnews.substack.com, because that's where I go live. There's going to be exclusive lives there. There's also a lot of exclusive content, and I put in every episode daily usually, unless I'm too busy, has a Substack newsletter that has a lot more information about every story every day. So a lot of times people are like, oh, you left out this detail in your report. No, actually, it's going to be in the Substack. So you need to make sure that you're following all of that. The effing community. I like that. Okay, so thanks for following, thanks for giving a shit, and thanks for joining me. I will see you